All right, let's just jump right into this. Have you ever stared at a global financial dashboard and felt like you were looking at two completely different realities happening at the exact same time? Well, welcome to The Explainer. Today, we're breaking down one of the most extreme market divergences we've seen in recent history. We're zooming right in on the data from July 9, 2026, because on that specific day, global markets were getting absolutely slammed with a massive wave of panic and sell-offs. But the US market, it seemingly threw up this invisible force field. So we're going to look at the hard data to figure out exactly what is dragging the world economy down, and what on earth is keeping the US so resiliently afloat. Now, you literally can't miss the visual contrast here. It's stark. If you look at the global heat map from July 9th, it's just this muted, painful red, spreading all across Europe, parts of Asia, and South America. I mean, it's the literal picture of global capital in full retreat. But then, boom, your eyes are immediately pulled over to the left. The United States is standing out as this dark, bold beacon of positive gains. It actually creates this wild cognitive dissonance for anyone watching the markets. How in the world can one single nation's market thrive so boldly while the rest of the map is just bleeding red? It completely defies traditional global market correlations. And that brings us to the ultimate question we're answering in this explainer. Why is the global market red, yet the US is still green? It's a massive mystery, but it's one we can solve if we stick strictly to the underlying data. To do that, we actually need to split our focus for a minute. First, we gotta understand the immense macro gravity that's pulling the rest of the world down. Once we get that, then we can look at the rocket fuel that's keeping the US propped up. So let's talk about that global drag. To understand it, we really have to look at the broader economic environment. Right now, the global economy is fighting off two massive, overarching pressures. Think of them as the two macro villains of July 2026. These are the heavy anchors that are triggering this widespread risk-off sentiment all across the map. Okay, so what exactly are these two threats? Well, threat number one is geopolitical tension. The breakdown of a US-Iran ceasefire has sent absolute shockwaves through the market, and it's driving oil prices into incredibly volatile territory. Then you've got threat number two, which is sticky inflation. The cost of living is stubbornly high, and surging bond yields are forcing central banks, including the Fed, to hold on tight to some really strict monetary policies. And that prolonged high-rate environment, it's essentially choking out broader economic growth. When we take those twin pressures and look at specific international zones, man, you really start to see the cracks. Take the European Central Bank, for instance. They are stuck in a serious trap right now. They're being forced to maintain a super strict anti-inflation stance with these high interest rates, even though their underlying economic growth is incredibly weak. And the data here brilliantly illustrates that fragmentation on a global scale. Look at the UK's FTSE 100. It dropped nearly 1.7%. That's a textbook reflection of the European sell-off driven by weak growth and high rates. But over in Asia, it's a much more nuanced story. It wasn't just a total wipeout. Japan's Nikkei actually managed a 1.4% recovery, and China's Shanghai Composite led the region, gaining an impressive 1.7%. So why the difference? Well, the data tells us this Asian recovery was largely driven by localized expectations. We're talking about anticipated economic stimulus, specific support for the real estate sector, and targeted cash flowing directly into tech stocks. Basically, it was regional triage, not overall broad market health. All right, strap in, because we're about to pivot dramatically. Let's look at the US. With all those heavy macro villains dragging down Europe and threatening global supply chains, you'd probably expect the US to be cratering right alongside them, right? But it's not. The US market has transformed into what the data is calling an AI locomotive. It's acting like this incredibly resilient, almost impenetrable shield against all that global macroeconomic gravity we were just talking about. Just look at the numbers. During a rocky, super volatile trading session on July 9th, the US forced a green close across the entire board. The tech-heavy NASDAQ surged up 1.3%, crossing over 26,200 points. The broader S&P 500 gained roughly 0.8%, pushing past that 7,500 mark. Even the legacy-heavy Dow Jones managed to squeeze out a positive gain, while the Russell 2000, which represents smaller companies, jumped over 1.2%. Guys, this isn't just surviving a global storm. This is thriving while everyone else in the neighborhood is busy boarding up their windows. So how is this even mathematically possible? Well, the secret is right here. Check out those massive, vibrant blocks of green concentrated super tightly in the tech sector. We are talking about the absolute titans here, Apple, and crucially the AI and semiconductor giants like NVIDIA and Broadcom. The analysis points directly to these tech, AI, and semiconductor sectors as the main engine, literally the locomotive that is single-handedly pulling the entire index upward. Investors are just pouring money into these specific companies based on massive Q2 earnings expectations. And what that does is create this powerful updraft, completely countering the global chaos that's happening everywhere outside of the tech sector. But as we all know, past performance is never a guarantee of future stability. If we zoom out a bit, we are actually witnessing a massive outlook pivot. The investment landscape for the rest of 2026 is fundamentally shifting right beneath our feet. Strategies that worked like a charm back in January, they might be incredibly dangerous by the time we hit August. If you trace the timeline, the first half of 2026 was just pure AI euphoria. It was an era where a rising tech tide lifted pretty much all boats. But now, as of July 2026, the sentiment is definitely shifting. Investors are getting cautious. They see the escalating geopolitical risks. They feel the sticky inflation. So they're moving into this new phase of careful, selective restructuring. Their number one goal right now, protect those massive gains they made in Q2. They are actively reevaluating and rebalancing their portfolios, just to make absolutely sure they aren't overly exposed to those global macro risks we looked at earlier in the explainer. Which brings us to our final, and honestly most critical question. Is the AI boom strong enough to carry the entire market through a macroeconomic storm? We are witnessing a genuinely historic divergence. On one side, traditional market sectors are getting heavily battered by inflation and geopolitical conflict. On the other side, you've got this US AI tech shield that seems at least momentarily invincible. But how long can a handful of tech giants really pull the weight of the entire global economy before the gravity just becomes too much? It's a thrilling, deeply important question, and it is exactly what you need to be watching as we navigate the rest of 2026. Thanks so much for joining me for this explainer. Keep your eyes on the data and stay focused.